What's up everyone, welcome back to another video with the Millennial Finance. A famed investor named Jeremy Grantham recently said that a super bubble that he previously predicted has yet to pop. This basically means that according to him, the recent decline in asset prices across the board has not yet gone through its full cycle and he expects further lows to come in the future. Let's see what he has to say. Cha-ching! Before we start the video, if you want to invest into stocks, cryptos, ETFs, or you just want to use a robo-advisor, then check out the links that we'll leave down below. We've got some great partnerships and some great options for new investors. Anyway, let's get started with the basics being what is an asset bubble. An asset bubble is essentially a rapid rise in an asset's price without any underlying fundamentals such as an equally rapid increase in demand. We heard this term a lot in 2020 and 2021, one of the best bull cycles in recent histories, and in hindsight, those moves were very clearly bubbles. Yes, at the time, companies like Zoom, they were growing earnings at a crazy amount every single quarter, but their stock price just went up way faster than their earnings growth, which basically defines a bubble. The reason it's called a bubble as well, this is at least my interpretation, is that bubbles, they rise, but eventually they will pop. But with nearly every single asset class across the board declining this year, and every investor wondering why they even invested their money in the first place, then the term bubble hasn't been used as much as it has in the years 2020 and 2021. But despite all of the pain that we've already endured, could we still be in a super bubble? So according to Jeremy Grantham, who is also the co-founder of an asset management firm based in Boston, we're still likely to see more price declines due to a few factors such as the stock, bonds, and housing market still being kind of overvalued, a commodity shock, and finally a hawkish Fed. So this is a bit to unpack, but let's go into his thoughts one by one, starting off with the overvalued asset classes being stocks, bonds, and housing. Firstly, I must say that without a shadow of a doubt, stocks were very overvalued over the past 2 years. Some people thought that, this is the new normal. PE ratios, price to sales ratios were a lot higher due to the large amounts of liquidity flowing through the markets, and I'm not gonna lie, even at one point, I thought the same way. Obviously, we can't all just become rich with a snap of a finger overnight so easily based off no fundamental gains, so stocks have given back a lot of the profits that it saw in the last 2 years. But the question is there still room to fall? So at the peak of things in December 2020, the price to earnings ratio of the S&P 500 index hit 38, which is about 2 times more than historical norms. For those of you who don't know, a high PE ratio kind of means overvalued, a low PE ratio kind of means undervalued. Of course, it's not that simple, but it's just a good gauge for beginners. Anyway, I don't know how I didn't think that was abnormal, that it was definitely going to retrace, but yeah, these things happen and they have given back a lot of the gains. So with the big price declines that we've seen in 2022 especially, the price to earnings ratio now sits at a way more reasonable level at around the 20 to 21 mark. This is about average if you compare it to the last 5 years, but it is still kinda high when we compare it to the last 10 years. So what we might think is that yes, stocks have retraced by a lot, earnings have also grown kinda okay, and the PE ratio is average, right? So why are we concerned? Well, the thing is, in bear markets, the valuations of stocks tend to overshoot to the downside, meaning stocks become way too undervalued compared to what their fundamentals show. This is similar to a bull market like we saw in 2020 and 2021, where the bull market brought stock valuations way too high. So in a nutshell, just like how bull markets make stock prices go way too high, bear markets will also make stocks go way too low. And at current PE ratios, it is definitely not way too low, it is actually slightly above average. With this logic at least, we could see further price declines or at least stagnating prices as earnings catch up until we find a true bottom. In terms of housing, there's no lack of news out there about how a housing crisis is coming in the US and Europe as well, and I've got to say that I completely agree with this view. The thing is, because liquidity was so high and interest rates were so low over the past 2 years, everyone and their moms was buying houses left, right, and center. Now that the Fed is raising interest rates, mortgages have gone up, and it probably will go up further as the Fed continues raising. This will then lead to defaults, meaning people can't pay off their mortgage anymore, and when borrowers default, banks will then try to sell off the house maybe through an auction to recover the loan amount, and when all the banks try to do this, they essentially undercut each other and can lead to a pricing decline of houses. Include the fact that buyers no longer want to buy houses due to the fact that interest rates are so high, and they've been reading the news that a housing crisis is coming, then this is a classic case of supply far outstripping demand. Basic economics, when supply is a lot higher than demand, then prices will go down until it finds an equilibrium. This is already playing out live, and very recently, home prices fell for the first time in 3 years, and it has shown the biggest decline since 2011. Next up, we also have a commodity shock. So we all know that inflation has brought about a higher price for commodities. So commodity stocks like oil and gas and fertilizers, agriculture, they have all been big winners recently. For a bit of good news, food prices have actually dropped for 5 months in a row, while oil prices have also started going lower. However, with the Russian invasion still ongoing and tense political situations in Europe, there is a very big risk of an energy crisis. A major natural gas supplier from Russia has recently suspended the Nord Stream 1 pipeline, which basically supplies natural gas to countries in Western Europe. By doing this, it has increased the chances of blackout and eventually further economic turmoil. A Michelin star restaurant in the UK recently stated on Twitter that their electricity cost for the month has gone up by 600% and warned that many businesses may even shut down until this is solved. On top of already slowing consumer demand due to quantitative tightening, this could lead to a spiraling impact on businesses who are seeing not only lower revenue but also higher costs. Yes, maybe this impacts smaller businesses more than the larger businesses who can't absorb the costs. The economy still revolves around these SMEs, and if they struggle, the economy will struggle as well. As if those first two things I was talking about wasn't enough, the Fed is still extremely hawkish in their views and is vowing to fight inflation no matter what it takes. In the latest Jackson Hole event at the end of August, Powell declared that the Fed must keep at it until the job is done, which is basically lowering inflation. This guy has gotten so popular, everyone tunes in just to see what he says, and the market reacts extremely volatilely whenever he speaks. The Fed have also basically acknowledged that for this to come true, for lower inflation to finally happen in the United States and many other countries, some pain must be expected in the form of a slower economy. Any hopes of a Fed pivot, thanks to improving economic data, has also been quashed, and that is something that I was expecting, to be honest, but it looks like it's not going to happen anytime soon. This is probably the best approach to take, as there's no point, trying to keep things going in the short term just for us to have more pain in the long term. This is sort of, the pulling off the bandit approach. Just kill the markets right now and let's move on. So in my opinion, having read what Jeremy Grantham had to say, I would say that his arguments are pretty valid, and there is definitely a scenario where we could see lower lows even by a big amount before we find a bottom. However, one thing that we need to take note of is that this guy is sort of like a perma-bear, as he's known for being able to call bubbles. He did it a few times, such as, the dot-com bubble in 2000 and the global financial crisis in 2008. So you must be thinking, this guy is very good at spotting bubbles, he did it before, so we must trust him this time. Well, the thing is, the way the media works is that they will only showcase the time that he called it right. There were times in the past where he called it and it was wrong, or it was just way too early, which is a standard thing for bears. Personally, I'm starting to realize that an economic recovery is still some ways off, and more bad news, especially coming from political tension, can bring the markets much lower. In my opinion at least, political tension and uncertainty is one of the biggest risks right now to the market because inflation is sort of under control. Having said that, we must remember that stocks tend to bottom before the economy. In fact, asset prices usually find their bottom right around the time when the economic data is at its very worst and news headlines are extremely bearish. So while I don't mind continuing my DCA investment plan for my stocks, cryptos and ETFs, I will still hold some extra powder just in case we see some very undervalued stocks in the near future. I won't stop investing because in my opinion, these prices are pretty good, I would say, but you still want the extra cash so you can go heavy in case it goes extremely low. So let us know down in the comments below. Would you invest your money right now? If you want to invest any of your money, if you're a beginner or even if you're experienced and you want to check out stocks, ETFs, cryptos, or robo-advisors, check out the links that we will leave down below. That's it for today's video, guys. Give us a huge thumbs up if you enjoyed it and subscribe to our channel if you haven't already. See you guys in the next one. Peace out.